Welcome everyone. It's yet another webinar on investing in China. I'm very pleased to have with me Louis-Vincent Gave from Gavekal. Welcome, Louis.
Thank you very much. Thanks. I'm delighted to be here.
Yeah, and you're founder and CEO of Gavekal. What is Gavekal all about?
So we're an independently owned money management and research firm based in Hong Kong and Beijing. We started about 20 years ago as a research firm, publishing macro research with a global macro research with a strong bias to China. Our vision at the time was that China was going to be a bigger and bigger piece of the global economic pie, and then most people had a blind spot. Most global investors had a blind spot relative to China, partly because they never had to look at China before. So we felt that there was a market to capture where we could explain what was happening in China to global investors. From there, we also built a money management firm, both in Pan-Asian equities and fixed income, and with a special focus on Chinese fixed income. Today, we manage, in Chinese fixed income, we manage about 1.6 billion US dollars, making us one of the bigger independent money managers into the Chinese fixed income space.
It's a hot topic these days. Everyone talks about China, but I can imagine 20 years ago it was different. So very keen to profit from all your knowledge, and let's go through the presentation.
Thank you very much. Before we do, I want to compliment you on your readings. I see that you have a couple of our books in the background. I think for readers who have the time, the two books you have in the background, especially the China's Asian Dream, no, the other one, which is the more recent one, that's really a great read. It was written by my colleague Tom Miller, and it's all about the expansion of the One Belt, One Road, and what China's trying to achieve, and which is something I'll be talking about in my presentation. So yes, you're right. Let's kick in. Let me pull up my slides. There we go. You can see those slides?
Yes, that's perfect.
Perfect. Look, I'll start off with a very simple observation, and that is that I think we forget as investors, even as human beings, we tend to focus disproportionately on scary events. That probably goes back to the days where we were cavemen, where each time we left the cave, we had to be worried that we'd be eaten by a tiger or beaten over the head by another Neanderthal. When something really scary happens, all of a sudden it captures all of our attention. And so, for example, if I asked you, what was the most important event of 2001, you would probably say it was 9/11. Because 9/11 was such, it was so traumatic. However, with the benefit of hindsight, as investors, we know that the single most important event of 2001 was China's entry into the WTO. That's what really changed the world for the following 20 years. By the same token, if I asked you what was the most important event of 2007, you probably would say it was the start of the subprime crisis. We had HSBC announce massive losses on subprime. We had BNP freeze a couple of money market funds. This basically started the unraveling of the mortgage bubble. And this was a scary event, no doubt, but with the benefit of hindsight, we know that actually the single most important event of 2007 was the launch of the iPhone. Again, as we look back, we can say that the launch of the iPhone created a new whole tech ecosystem that has been driving markets ever since. The reason I highlight this is obvious enough. Today, we're all chasing our tails on what COVID means, right? It's all day, every day, partly because we're stuck, most of us at least are stuck at home because of COVID. Clearly, this year has been the most anomalous year any of us managing money or actually just going about our lives have ever had to face. And so it's COVID all the time, COVID every day. what I'm going to try to argue in my presentation is that 10, 20 years from now, when we look back on 2020, maybe COVID won't be seen as the single most important development. And I'll come back to that. Now, perhaps COVID isn't a very important development, but it's pretty obvious that the policy responses to COVID are going to have a big weight going forward. I think if you look all across the Western world, what you find is we've been hit by COVID, and everywhere you care to look, the policy response has been a massive increase in budget deficits funded by massive printing by central banks. So, here I've got the United States as an example. The US budget deficit this year has increased by $4 trillion. That's with a T, 4,000 billion, $4 trillion funded, basically 75% directly by the Fed. The Fed balance sheet has expanded by $3 trillion. This is simply unprecedented. Never before have we seen such increases in government debt all across the Western world at the same time, funded by money printing. And we're seeing this, to be honest, I don't mean to pick on the United States. We're seeing this everywhere. We're seeing this everywhere except for one major country, and that major country is China. And I think this is very interesting because I first moved to China in 1994. And since then, every time you had an economic slowdown, you could almost bet on China having the most Keynesian response. Whenever you had an economic hit, China would increase government spending, would increase its monetary aggregates, would push its banks to lend. By and large, China was always the most forward and aggressive Keynesian economy out there. Fast forward to today, to the COVID crisis, and we have the biggest global hit to economic growth, and China sits on its hands while everybody else is doing money printing and fiscal expansion. So why? Why this massive divergence from China, not only from everybody else, but also from its own standard operating procedures? Again, historically, China would have always been the first one to print and the first one to stimulate. Today, China is sitting on its hands. And if ever a chart illustrates this, for me, it's the difference in the size of the balance sheet between the PBOC, the People's Bank of China, the Chinese central bank, and the Federal Reserve, the US central bank. The Federal Reserve balance sheet has grown from 4 trillion to 7 trillion in the space of a few weeks, while the PBOC balance sheet has basically been flatlining on your left. So, why this dramatic divergence? For me, this is the question that every investor should ask itself, because I think there's a very important message there. Why would China, deviate so much from what it usually does? I think there's a cyclical explanation and there's a structural explanation. The cyclical explanation is a pretty simple one. The cyclical explanation is that Chinese policymakers are deadly afraid of inflation. They're deadly afraid of inflation because even though they are not, they may not look or feel very communist anymore, they were still brought up in the Marxist church. And if you're a Marxist, if your core beliefs are Marxist, you believe that big events in history, revolutions, changes of regimes, social instability, etc., are driven not by individuals and not by ideas, but they're driven first and foremost by economic forces. If you're a Marxist, you believe that it's economic forces that shape history. And for a Marxist, there is no more powerful economic force than inflation. So, Karl Marx explained that Louis XVI lost his head because in France, we had very bad harvests 2 years in a row. And so by 1789, the population was very angry because food prices were going up, and the population being angry, they revolted. And next thing you know, his head is on a spike. Just as if you talk today to Chinese policymakers, they'll tell you that the student revolts of 1989, the Tiananmen revolts, had a lot more to do with the fact that at the time, Chinese inflation was running at 25% than the fact that students wanted democracy, students wanted more freedom, etc.
Okay.
Now, I actually don't believe that, but what I believe doesn't matter because what matters is what the guys at the top in China
believe. Yeah.
They're the ones making the policy, not me. And so they firmly believe that inflation, whenever inflation starts to appear, you need to stamp it down, lest you start to having social problems. And the reality was at the beginning of this year, inflation in China was running at 5%. It was running at 5% because before China had COVID, you may remember that China had the swine flu. And we don't talk about it anymore, but at the time, the swine flu felt like a very big crisis. China had to kill half of its porks. Put this in perspective, China has half the porks in the world. So that means that China had to kill a quarter of the global pork population. Pork prices went up 70%. And pork is the main meat in China. So this was creating a real problem. Therefore, with inflation at 5%, it's very possible and very likely that the Chinese government felt we can't print a bunch of money, we can't do a big fiscal spending. First priority is kill inflation. And in that regards, the Chinese policymakers are already very different than the Western policymakers. The Western policymakers are all telling you today, we want inflation to accelerate. We want to do everything we can to have inflation. The only part in the world, the only policymakers in the world that are telling you the last thing we want is inflation today are to be found in China. Now, the second reason I think to explain this big divergence in policy from China relative to its own history and the rest of the world is where China stands in its own development. And here, I just want to make a very simple point, and that is that Xi Jinping, the current Chinese president, is the first Chinese leader since the Ming Dynasty to really have a foreign policy, to start looking abroad. Before then, if you were a Chinese leader, you came in and you had enough domestic problems that you didn't really, matter what the barbarians were doing. The barbarians could take care of themselves. You would focus mostly on what was happening in China. And Xi Jinping's foreign policy is a fundamentally imperialist policy. And when I say imperialist, I don't mean that China is going to go and invade Vietnam or the Philippines or whoever else, but that the history of every empire is first and foremost a road building exercise. That's what empires do. They build roads to bring in commodities cheaper and push out finished goods to the outer realm of the empire. And that's the theme of the book we were just talking about, the China's Asian Dream that's standing behind you. The story today of Chinese policy is an attempt to tie all the economies that you see on this map to China's economic orbits through roads, through canals, through railways, through telecom lines. And, in Europe, we say all roads lead to Rome, highlighting that that's what empires do. They build roads. For Xi Jinping in the 21st century, all roads lead to Beijing. Now, this is all well and good. You've built out all these roads to promote trade, to promote more exchanges. Now, having done that, if the trade along these routes, new roads, is still denominated in US dollars, that means that China remains a tributary, which is what's happening today. Then China remains a tributary to the US. It remains dependent on the ability and willingness of American banks to fund this trade. And that, of course, is unacceptable to Xi Jinping and to the Chinese leadership. And which brings us today, I think, to the biggest contradiction or the biggest anomaly in global markets. And that is that China is now more than 15% of global GDP. It's roughly 15% of global trade. It's more than 25% of global central bank reserves. Yet the renminbi is not even 2% of global trade settlement. There's a huge mismatch here between, on the one hand, China's importance as an economic power and China's importance as a financial power. And that's, of course, because, 20 years ago, China was nowhere as an economic power. It's risen very quickly as an economic power. And now the financial realm needs to catch up. So if you're Xi Jinping and your main goal is to promote more trade with this whole area and for this trade to start moving into renminbi so that you are no longer dependent on the US dollar, there's the first way you can do this, of course, is by making sure that the renminbi is a strong currency in its own right. When China goes to South Korea, to Indonesia, to Saudi Arabia, or wherever, to Russia and wherever else, and say, look, instead of trading in dollars, let's trade in renminbi, the guy on the other side of the table wants to be sure that the renminbi he accepts aren't going to be devalued tomorrow, that he's not going to lose a bunch of money. Take Europe as an example. Europe in the 1950s and 1960s, most of the trade was settled in US dollars. As the Deutschmark built credibility, Europeans started to feel more comfortable trading in Deutschmarks rather than US dollars. But the reason the Deutschmark won credibility is the Deutschmark was perceived as a strong currency. Nobody wanted to trade in Italian liras or Greek drachmas. And the same is true in Asia. And today, China is building this credibility. If you look on a 12-month basis, a 3-year basis, a 5-year basis, a 10-year basis, if you look at the total return of the currency, i.e. the currency move plus the interest rate compounding, you find that the renminbi has outperformed all other currencies in the world. So on any meaningful time frame, again, 12 months, 36 months, 5 years, 10 years, the renminbi is the world's best performing currency. And thanks to that, the renminbi bond market is, since the bond market started to open to foreigners in 2012, the renminbi government bond market is the only government bond market that has outperformed the US Treasury market since 2012. And I think there's a very important message there. It's all the more important since today, when you look around the world, China is really the only place in the world where you're going to find positive real interest rates. Now, this matters greatly. It matters greatly because for most investors, bonds are the building block of your portfolio. They're the first building block. There's basically the foundation on which your portfolio rests. You know, you pour your foundation to keep the house sturdy, to keep the house from not blowing away in a storm. And that's what bonds do for you, right? Bonds, whenever there's, the markets are challenging, bonds, for whatever reasons, bonds keep your portfolio together, just like the foundations of your house. The problem, of course, is that bonds that yield 2% real, 1% real, do not have the same attributes as bonds that yield -1, -2, -2.5% real, which is where we are today in Germany. And bonds that yield -1, -2% real no longer do what you expect them to do. When bond yields are this low, bonds can no longer protect your portfolio. And so today, if you're an investor and you think, okay, I need to find positive yielding bonds and positive real yielding bonds to cushion the risk in my portfolio, there's only really one place you can find those, and that is China. China is the only market left in the world still offering investors real positive interest rates.
What we see here is the 1-year rate, but for example, 10-year rate on China. At what level is it at present?
It's roughly the same because the yield curve is very flat today in China.
Very flat. Okay.
It's very flat, so it's going to be in the same ballpark.
Yeah, and I had another question. On the strengthening the renminbi, do you see any role there for this digital currency, this DCEP that China is raving about, or is that future stuff?
I think it's extremely, extremely important. If I may, I'm going to talk about it in a minute because I have a section on that, and I think it's key.
Okay, very good.
Yeah, if it's okay, I don't mean to not answer your question. I promise you I will answer.
I'll remind you.
So China is very clearly trying to roll out its empire, and to do so, it needs to, build its own currency as a trade and reserve currency. Now, the problem, of course, when it does that, is it goes straight against the United States. Because if I asked you, what's the U.S. biggest comparative advantage? It's actually a funny question because when you ask people what's the U.S. biggest comparative advantage, when you ask Americans, they say, oh, we have the best entrepreneurs, or we have the rule of law, or we're a democracy, so maybe, or all these things. And then you say, well, lots of places are a democracy, lots of places have the rule of law. And when you ask foreigners what's the biggest comparative advantage of the United States, the first thing they say is, oh, it's easy. The US has the world's reserve currency. And having the world's reserve currency and basically sucking in the savings from everywhere around the world, it means that the US has no constraints on its trade balance and no constraints on its budget deficits. Now, of course, the challenge today is China is basically trying to do the same thing as the US, build its own trade and reserve currency, at a time where US debt is absolutely exploding. In the past 10 years, US debt has gone from 60% of GDP to 140% of GDP, US government debt. And so this challenge to the US dollar's hegemony is coming at perhaps the worst possible time. And so the US pushes back. And the US pushes back on three fronts. The US has, is pushing back against China. First, has launched a trade war. Second, has launched a tech war. And third, is launching a financial war. And that's where the digital renminbi will come in. But first, very briefly on the trade war, this was started 2.5 years ago by President Trump. And I would say that I think it's a dud. It really hasn't crippled China at all. The trade war, if you look at the willingness of multinational companies to do business in China, it really hasn't moved very much. And perhaps the most telling aspect is China's trade surplus. The numbers don't lie. China's trade surplus today is at a record high, in spite of the trade war. China's trade surplus is $60 billion a month right now. So that means that there's 60 billion coming in every month into China, while at the same time, you're seeing massive investor inflows into the Chinese bond market for the reason we've just highlighted. More and more investors are waking up to the fact that not only is the renminbi a strong currency, so I want exposure to it, but at the same time, it's the only currency that gives me real positive interest rates. And of course, the two are linked. With real positive interest rates, your currency is strong. And so capital is now flowing into the Chinese bond market. The Chinese bond market has gone from being 1.5% owned by foreigners to 3% owned by foreigners over the past 3 years. And the trend for me is very obvious. We're going to move from 3 to 5 and 5 to 10. The only question is not whether we go from 3 to 5, but how quickly we go there. Now, this, of course, raises a quandary for the Chinese policymakers, because today you have massive capital inflows coming from the bond market and record high trade surpluses. So that means there's a lot of money coming into China. And if you're Chinese policymakers, what do you do about all that money coming in? The first, historically, what China would have done is print a bunch of renminbi to prevent the currency from rising too fast, right? To basically absorb all the excess dollars coming in by printing more money. But if you do that, you risk inflation and you risk a domestic asset price bubble. So they're not doing that today. You're not seeing the growth in monetary aggregates. Your options are thus to let the renminbi appreciate, which is what's happening, and or to try to push all this excess money coming in back out as quickly as possible. So, on the renminbi bull market having started, I think it's, we've obviously been rebounding very strongly over the past 6 months. And it seems that the downward trend that we had really from 2014 to 2019 is coming to an end. Now, this is very important because when the renminbi was basically on the weaker side, people were still making money thanks to the interest rate differential, but the renminbi was on a downward path. That was deflationary for the world. Everything that China produced was cheaper and cheaper. And that meant constrained interest rates in the Western world. That meant outperformance of growth stocks versus value stocks, etc. The rising renminbi, make no mistake about it, is inflationary for the rest of the world. To the extent that everything we buy today is made in China, a rising renminbi should translate into higher costs for the rest of us. The other thing, of course,
just one sec, Louis. On your previous slide, You say China may be buying gold and maybe buying Bitcoin. Is there any evidence that China is pouring money into Bitcoin? Because then we haven't seen the end of that yet.
Oh, we haven't. No, we haven't seen it yet. So the Chinese government would not buy Bitcoin. That seems highly unlikely to me. But Bitcoin has always been a vehicle for Chinese people to get money out, right? Partly because China still maintains some capital control. So if you're Chinese and you're, all of a sudden making a bunch of money because you're exporting more and more around the world, and you're a Chinese entrepreneur and you want to hide some of that money from the government because you don't trust your government and you just want to have at least some of your savings hidden from the government's view, you don't have that many options. Option one is gold. Option two is Bitcoin. And that's basically it. Okay. Option three, actually, sorry, there's a third option. Option three, which, well, usually there's a third option. Right now that option is constrained. But option three is you go to Macau and you basically take your money out of China through the help of the casinos. The casinos take their 5% cut and you push your money out. But right now you can't because of COVID. So, big parts of China can't go to Macau right now. Macau is gradually reopening though.
Okay, clear.
But the other way, of course, China can push its money out is, and that's more at the top-down level, is by making huge inventories of oil, inventories of copper, inventories of the key commodities that China needs. So just a few numbers for you. China, a couple months ago, was importing 13 million barrels per day. To put things in perspective, in 2019, China was importing an average of 9.5 million barrels per day. So it went from 9.5 million barrels per day a year ago to 13. 13 is huge. Given the slowdown in economic growth, there's no way that China's using 13 million barrels per day. Or look at copper. In 2020, China's importing twice as much copper as it was in 2019. Again, when you look at the underlying economic growth, that doesn't make much sense. So what these charts tell you is that not only is China's trade surplus very high today, but it's likely to stay high for a while because today it's actually being constrained by the purchase of commodities for tomorrow. So tomorrow, if commodity prices go through the roof, China will have the option to just back off and not buy commodities. So all this to say, the trade war has been a bit of a dud. The second front that the U.S. has opened against China is the tech war. And here the tech war is much more problematic. It's much more problematic for China. The tech war, in essence, the U.S. has said, look, we own most of the intellectual property around semiconductors, even if we don't produce them anymore because they're being produced in Korea, in Japan, in Taiwan. Even if we don't produce the semiconductors, they're produced on U.S. patents. And we don't want those semiconductors to be exported to China anymore. And this has basically meant that companies like Huawei and ZTE and SMIC are nearing death. They're at death's door. If they can't import semiconductors, it's really problematic for them. And it would be problematic for anybody because we probably, in today's world, at least according to the financial markets, semiconductors are now more important than energy. Semiconductors are seen as the commodity of the future. This chart on page 23 highlights the market cap of semiconductors relative to the market cap of energy globally. And while semiconductors used to be a fifth, a sixth of the market cap of energy, in recent years, in the past year, it's moved to being 50% bigger. So today, the market is telling you semiconductors are more important than energy. And now all of a sudden, the US is telling China, you can't have access to semiconductors. Just like the US told Japan in the 1930s, you can't have access to oil. Now, this creates a potential, this plants the seeds for a massive problem going forward. Because for me, one of the key events of 2020, we started this chat about what the key events of 2020 would be with the benefit of hindsight. with the benefit of hindsight, I think we'll look at this chart as a key event of 2020, because this chart highlights that the United States passed on the technological leadership on semiconductors from the US to Taiwan over the course of the summer. This past summer, TSMC came out and said, we have started production on 7 nanomillimeter chips. Intel came out and said, we thought we'd be able to get to 7 nanomillimeter chips by 2021, but we're not going to be able to do it until 2023. And with this announcement, then TSMC said, well, by 2023, we'll be producing 3 nanomillimeter chips. So in essence, Intel has now been left in the dust. And you see this very clearly in this chart, where the TSMC market cap doubles from the summer, while the Intel market cap falls by a third. TSMC is now, is far ahead of Intel. It's now more than twice the size of Intel.
Very live with the Apple event this week, right? Because Apple now stopped after 50 years with Intel, and they work together with TSMC on their chips.
No, it illustrates the passing of the technological baton from the United States to Taiwan. In essence, you have two big chip producers in the United States, Intel and Micron. All the other guys, your NVIDIAs, your AMDs, your Broadcoms, etc., they're chip designers, but somebody else produces them. And what happened this summer is the US basically said, we can't compete with Taiwan in the production of chips. And yes, Apple says, okay, fine, Intel, see you. I'm moving to TSMC. Now, this matters because this basically means, if we start off with the premise that semiconductors are the single most important commodity in the world, and that Taiwan now has the far ahead the leadership in that, that means that Taiwan is really the new Saudi Arabia of our geopolitical world. Now, this is unfortunate because Taiwan basically sits right in between the United States and China. On the one hand, Taiwan is part of the Western world. It's a democracy. It has all the freedoms that you and I have, etc. But on the other, China says Taiwan is part of China. And there was this uncomfortable status quo at the best of times. There was the uncomfortable status quo when the US and China got along, and when Taiwan really didn't matter very much. When Taiwan was producing cheap toys, who cared? But now that Taiwan produces the single most important commodities, that the US has decided that this commodity would be what they use to put pressure on China. And that China and the US no longer get along, you obviously see that the stage is set for massive tensions surrounding Taiwan. So what happens is this chain of event keeps on repeating, whereby the US tells China, we're not going to export semiconductors to you. China launches military maneuvers in the Taiwan Straits, in essence telling the US, well, look, we know where the semiconductors are. They're 100 miles off our shore. We can go get them. And if we can't get them, then you can't get them either. And then the US says, well, if you do that, I'm going to block access to the US dollar for you. Which brings me to the third front of the US pushback, the capital war. The capital war, where increasingly you're seeing more and more financial measures destined to block access to the US dollar markets for Chinese entities. Now, initially it's just, a few companies involved with nasty stuff in Xinjiang, or the individuals involved with the repression in Hong Kong, etc. But the US has now put the US dollar card on the table. And it's a very threatening card because it's a card the US has used before, right? It's how it's taken down Iran. It's how it's taken down Venezuela. If you get cut off from the US dollar funding, if your banks are no longer able to settle in US dollars, then of course it makes international trade almost impossible. Now, what's China's reaction been to this? China's reaction to this has been, well, if the US is going to cut me off from the global financial markets, if it's going to cut me off from US dollar funding, then I need to have my own financial markets to replicate whatever I do with the US. Now, it turns out I actually have one. I have Hong Kong, a credible financial market, but I don't fully control it. So I'm going to go ahead and take Hong Kong over. And that, of course, is what Xi Jinping did this past summer. And when he did, I think this past spring, sorry. When he did, I think the reading amongst foreign investors was very wrong. Most people thought, oh, this is the end of Hong Kong. This is terrible. Hong Kong dollar is going to collapse. People are going to flee Hong Kong, etc. And you've seen none of that. You've seen none of that because, in fact, now that China owns Hong Kong, now that Xi Jinping has made the Hong Kong issue his problem, he has no choice but to turn Hong Kong into a success. Hence a flood of IPO to Hong Kong, hence the deregulation of the Chinese bond market through Hong Kong. And all of this, in essence, trying to make Hong Kong China's financial market so that China is no longer dependent on the US dollar. And that brings me to your question on the digital renminbi. And I'm sorry it took me a while to get there.
No problem.
But China, you could say, has an impossible task. China needs to de-dollarize itself and convince its partners to de-dollarize. And it's extremely hard because today most of global trade is done in dollars, right? And to replace the dollar, you need to have a currency that's not just marginally better, but massively better. The analogy I use is Microsoft. I'm going to assume that you use Microsoft. Most of our clients use Microsoft. And the reason they use Microsoft is everybody else uses Microsoft. And so you can exchange files. And if you hire somebody new, they come in and they know exactly how to use all your systems. So, again, everybody uses Microsoft because everybody else uses Microsoft. Fast forward, so in essence, Microsoft is it's the dollar of the world's IT systems, or the dollar is the Microsoft of the world currency system. Now, go back to 2006, 2007. Back then, the view was Apple is a nice little company. They've got some neat products, but Apple will never be able to compete for the corporate IT spend. They'll never be able to, get the business of Goldman Sachs, of General Motors, of Unilever, of Carrefour. It does. That business will always go to Microsoft. So Apple will always stay this, smart little company on the side. Microsoft will remain the behemoth. What Apple did, of course, was it went out and it created a parallel system. It said, you know what, I'm not even going to compete for the corporate IT spend because I know I can't get that. I'm not going to compete for the corporate IT spend. I'm going to build a parallel system built directly on the consumer. So the iPad came out, the smartphone came out, and with the iOS system, China captured a whole new ecosystem that we didn't even know existed. And in so doing, became more than a competitor to Microsoft. It actually bypassed Microsoft. This is, I think, what China's trying to do today. Combining its fintech companies, whether Alipay, Ant Financial, WePay, etc., combining that with a digital currency opens up the possibility of a whole new operating system for settlements that no longer pass through SWIFT and no longer pass through the US dollar. Tomorrow, your Jakarta businessman on a trip to Singapore will be able to pay his hotel room with his phone without going through Visa, MasterCard, without going through the SWIFT system, without going through the US dollar, but simply by going through Alipay and the digital renminbi. This will be the feature of how money gets settled all around Asia. So what I'm saying, I guess, is the digital renminbi is China's attempt to be the Apple to the US dollar's Microsoft. Create a parallel system that allows the renminbi to exist without going after the business that the US dollar does today. So if you, the conclusion for me on all of this is when you look at the geopolitical trends, China today really has no choice but to internationalize its currency. And China can internationalize its currency in one of three ways. It can do so by opening its capital account. And that's how most Westerners look at this problem, because that's, what the economic textbook tell us. That's what people tell us to expect, but that is not what's happening. Ergo, most Westerners look at China and say, well, they're not opening their capital account, so this is never going to happen. But China can also internationalize its currency in different ways. The first is by using gold as a halfway house, and that's already happening. So China goes to Russia. China signs a 50-year deal to buy oil and natural gas from Russia for renminbi. And against that, when Russia says, well, yes, this is all well and good, but I don't know if I want to keep renminbi, China says, well, look, you can exchange your renminbi for gold, either in Shanghai or in Hong Kong. And in this way, you can trade oil for gold without ever going through the US dollar for the first time since World War II. Yep. The third way China can internationalize the renminbi is by creating a new settlement system, which is what we just described with the digital renminbi, and similar to what Apple did with Microsoft. But however you cut it, China, if it wants to give itself the possibility of success for its geopolitical ambition, really has no choice but to make the RMB bond market a success. And it also has no choice but to make Hong Kong a success. And on this, I'd love to take any question that you might have.
Well, I think the central question that pops up to me is, the US government now with this change to Biden, will this change anything? If the tone of voice of Trump was so fearful. I saw when Biden was elected that, for example, the shares of SMIC went up 7%. So apparently the market is expecting it to be lighter, but will it be? Because there's so much at stake for the US. What's your view?
There's a lot at stake for the US, which I think is why being anti-China is one of the few, I'd say, bipartisan issue in the United States. You have both senators from the right, like Rubio in Florida, and from the left, like Chuck Schumer in New York, that spend half their days bashing China. So it's really one of the few issues where the left and the right in America agree. Having said that, they agree that they want to contain China's rise, and China is well aware of that. I think there's definitely divergence as to how you do it. And to how you proceed with containing China. Interestingly, during his campaign, Biden has talked very little about China. I think partly because he felt that this wasn't really a strength for him. Because I think whether you like Trump or not, we have to give at least Trump some credit for changing the narrative around China. Trump sole-handedly shifted public opinion around China in the United States and political opinion around China in the United States. So Biden was never much of a China hawk before, when he was in power with Obama or even as a senator. He was always very happy to talk about China's rise, and he was, to China's entry in the WTO, etc. So during the campaign, he really didn't talk much about China because he didn't have much of a leg to stand on against Trump. So, we don't really know what Biden is going to do about China. What seems likely is that, Biden is very much an internationalist and of the view that to address a problem, you need to build a big coalition, which is how Obama tried to deal with China, right? The Trans-Pacific Partnership, try to get all the US allies to agree on a position against China. And from the little Joe Biden has said, I think that's his plan. Now, the obvious problem with that is that building big coalition, getting everybody to agree on a stance towards China, etc., is going to take a lot of time. It's not going to be done in the course of a few weeks. Number one, and number two, not only does it take a lot of time, but it's not going to be that easy. It's not going to be that easy because if we look at Europe, there's a number of European countries that aren't going to feel that comfortable taking a strong stance against China. Take Germany as an example. Germany is moving to a more and more pro-China line, partly as the big German companies, whether you're Volkswagens, whether you're Bayers, whether like increasingly their number one market is China. So it's going to be hard to rally everybody on a big anti-China stance. So my take on Biden is he's going to come in, and China's going to initially fall by the wayside. It's going to fall by the wayside because he's going to feel that he needs to get his economy started again. So he's going to want to do a big stimulus bill. His first priority that he keeps talking about is green energy and climate change, etc. So he's going to want to be seen to be doing a lot on that. He's going to want to be seen taking down unemployment. And with all that, China will just fall in the background. Now, it'll be interesting to see who he nominates in the State Department, because I think whoever he nominates in the State Department will be responsible for the China brief. Now, today, Mike Pompeo is one of the most anti-China guys out there. He's extremely, extremely anti-China. So whoever comes in, I don't think will be nearly as anti-China as Mike Pompeo. But it'll be interesting to see if China is a priority or not. But if it is a priority, it will be by trying to build a big coalition. And again, that will take time. So I think we have a window of at least a couple of years where the China bashing will be far reduced. And again, that's assuming that Biden is confirmed, which right now seems likely, but it's still not 100%.
So, but it would also mean in this scenario, no concrete military action around Taiwan. It's all power play, and it won't erupt.
So I think it should mean, if I'm right, and again, Biden has said so little about China that's it's hard to gauge, but if I'm right, it should mean that the tech war should take a step down. The tech war should abate, because I think Biden won't want to add oil to the situation. If the tech war abates, China's threats on Taiwan will also abate, and so that will reduce the tensions on Taiwan indeed. But that's what I think will happen. But I could be wrong.
Yeah. Hey, and turn it completely the other way around with Biden and his number one goal on climate change after COVID has been tackled. Climate change is on the agenda in Europe. Climate change is now also on the agenda in China. Could it be one world common goal where the US and China work together, or is that too much of a rosy dream to get going? Could they trade
No, I don't think it's a rosy dream, partly because, yes, to your point, I think every policymaker today in the world wants to be seen to be doing something about this. And so I think there is the opportunity for Biden to meet with China and to say, look, I don't like all the tariffs that Trump put in. I don't, especially on our farmers, it's hurting our farmers, etc. If I lift the tariffs that Trump put in, what can you do for me on climate change? I think a deal like that can exist, and then Biden can come back and say, I've negotiated a global climate deal that's even better than the Paris Accords. Yeah. That's even bigger. China signed up for this. China signed up for that. And I think I think there is a deal there. There is a deal there because China would be happy. Let me put it to you this way. China today would be happy to trade things that cost money for more freedom and more power. And so if you think, okay, a climate deal costs China money, China today is of the view, I think, that, well, we can afford this if we get something on the other side. So, perhaps, I think that's a very valid point. Perhaps we all start off with a feel-good feeling of a global climate deal that gives Biden a first win and gives Xi Jinping a win as well in the form of falling tariffs.
We'll have to wait and see. My last question is on Hong Kong. Yeah.
Yep.
You clearly stated, China has no choice to make Hong Kong a success.
Yes.
On Hong Kong itself, there was yesterday this news about the law changes that make these judges stand up and go away. We also had this new regulation on.
It wasn't. Sorry to interrupt. It wasn't the judges. It was the lawmakers.
Sorry. Yeah. The lawmakers, but
basically the elected officials.
Yeah.
Sorry.
And you have this new regulation for Alibaba and Tencent and Meituan, the entire industry. It raises again questions in foreign countries. You know, is the Chinese government to be trusted? You know, what else do we see? Is this just the things to include Hong Kong in China, or can we expect more of these changes?
Look, I think these are great questions. So it's obviously different events. The regulation and the antitrust move against big tech is one thing, and the crackdown on Hong Kong dissent is another. But fundamentally, at its core, you could say it's one issue. And the one issue is the Chinese Communist Party asserting control. At its core, on either side, if you look at what's happening in big tech, it's the Chinese Communist Party telling the tech companies, don't forget who you work for. Don't forget we're the bosses. Nobody is more powerful than us. That's the message that was sent to Jack Ma and to Pony Ma, who perhaps, not so much Pony Ma, because Pony Ma is the owner of Tencent, is very discreet, but Jack Ma, or the CEO of Tencent, but Jack Ma has been very vocal in recent weeks and recent months, and I think it's the big challenge in China is when you get too big for your breeches, the government knocks you down a peg. Any politicians anywhere in the world is always very jealous of its political power, but it's especially so in China. And anything that is perceived to be putting into question the strength of the Communist Party is attacked very violently. And so Jack Ma had, I think, the hubris to do this. And so he's been brought down a peg and basically had to fall back in line. Hong Kong, so in Hong Kong, to some extent, is the same story. It's the Chinese Communist Party asserting its control, saying, "Look, this is it, and you have to toe the line." And I think this sort of insecurity of the Chinese Communist Party it's deeply embedded in the Chinese psyche, in that if you look at China, basically from 1860 till 1990, you basically had 130 years of just misery, right? Famines, wars, civil war, foreign invasion, cultural revolution, great leap forward. There was probably nowhere worse in the world to live in between 1860 and 1980 than China. 1990 than China. It was just misery. And with that comes a huge premium to social stability. And so China today, the Chinese Communist Party, most people in the Western world think that the Chinese Communist Party gets its legitimacy from its ability to deliver economic growth. That's not the case. The Chinese Communist Party gets its legitimacy by its ability to deliver social stability, because social stability comes at a huge premium. And so when things come that threaten this social stability, i.e. Hong Kong, i.e. companies getting too big for their breeches, they get knocked down very violently. And yes, as an investor, it's disconcerting. I would say, especially as an equity investor, it's disconcerting. As a fixed income investor, I'm less troubled, because in essence, as a fixed income investor, you crave stability, right? You don't get the upside. Now, in any economy, whether the Dutch economy, the Chinese, the American, it functions because you have rentiers that provide capital and entrepreneurs that use this capital.
Yep.
Now, some countries traditionally always favor the entrepreneur against the rentier, and the rentier gets spoiled over time. This is the case, for example, in the United States. You see it each time the stock market goes down, they collapse interest rate to try to help the entrepreneur. And too bad if the rentier ends up with lower returns. Today, all across the Western world, the rentier is being told, we're going to destroy your capital. I mean, that's basically what negative interest rates mean, where the rentier is being told, we're going to destroy your capital. In China, what the investors are being told is, we don't care so much about the interest of about the returns of the entrepreneur as much as we care about the interests of the rentier. Because A, we're an aging society, and B, if we destroy the returns of the rentier, we risk social instability. And social instability is the end-all be-all. And to get social stability, we have to make sure that the rentier keeps on getting a high return, because, you know, Chinese people are savers, and so we need to provide them returns, and that is what's happening. So, a very long-winded answer to your question, but I think everything that I have seen this week has reaffirmed my belief that you want to be invested in Chinese bonds for the long term, maybe less so in Chinese equities for the long term. I think that's more debatable. But the Chinese bonds, you know, there's a commitment of the government to make sure that Chinese bonds deliver good return.
I think it's a very clear and a very strong answer, and I'm with you. I'm with you. Did you have one slide to conclude the presentation, or do we start with?
Sure. You know, so I wrote a book which should also be on your bookshelf. I'll make sure that Hank sends you a copy. I wrote a book a year and a half ago called Clash of Empires, basically explaining how the world was, you know, breaking apart into three empires. A U.S. empire, a European empire, a Chinese empire, and how each one of these empires would have its currency of reference, its financial center of reference, its bond market of reference. Now, you know, so if you look at China today, you know, China's potential empire is really the broader emerging markets, which is the fastest growing part in the world. And hence it's the need to internationalize the renminbi. Hence the need to take over Hong Kong to have the financial center of reference. Now, China does tick a lot of the boxes today to be an empire. It does have technological centers in Shenzhen and Hangzhou. It increasingly does have a military. It isn't energy independent. It does have a space program. So it ticks a lot of the boxes. The challenge, I think, for Europe is Europe, you know, has tried to be an empire. And when you think of Europe as an empire, you know, you start off with 6 countries, then you move to 9, then 10, then 12, then 15, all the way to 27. It's like, you know, those sprawling maps. So if you think of the European Union as an empire, it kept growing, but it is now done growing. It's done growing because on the eastern border, Russia is basically standing there and saying, look, you can't grow anymore. We tried to grow into the Ukraine and we were told that we couldn't. And it's actually losing parts of the empire. And perhaps worryingly, it's lost its financial center in the form of London. But perhaps the most worrying thing of Europe as an empire is we really don't have a technological center.
Yeah, that's a painful question mark.
Yeah, we also don't have a military, which is challenging to be an empire. So I think you can question, you know, if the euro is an imperial currency like the US dollar, like the renminbi, structurally and over the long term, how the euro can remain the structural currency and an imperial currency without a military, without energy independence, without a space program, without a technological program. You know, to me, all that puts a big question mark on Europe's ability to basically withstand the assault of the renminbi and the US dollar over the long term. And so I think if you're a European investor, you have every incentive to export capital. And if you're a European rentier, you should export capital to where you as a rentier are not being told by the policymakers that they want to destroy your capital, but instead are being told by policymakers that they want to reward your capital.
And that is exactly my point, where I also started this sequence of China webinars. You know, you don't have to put all your money immediately away from Europe, but at least to diversify into other regions, and particularly to those where you don't have any allocation yet, because as far as I'm aware, all Dutch investors are far underweight Asia and China. So that's a very good opportunity.
Well,
should people have an interest in the China
So on this point, I think it's very important. In a world that is increasingly, you know, a decade and a half ago, I wrote a book called Our Brave New World. Thomas Friedman wrote The World is Flat. The idea was we were living in one globalized world. And that if you wanted to invest in China, maybe you could just buy Unilever or LVMH, and you know you would get China exposure, etc. And that was all well and good in a world that was increasingly globalizing. But in a world that's breaking apart into three separate empires, investors should not have all their eggs into one of those three baskets. You want to have eggs in all three baskets. You want to be able to be spread out. And because having all your eggs into one of those baskets is going to be increasingly dangerous. And you know, if you think that you own China and you're gonna play China by owning LVMH or owning Royal Dutch Shell, etc., it's no longer the case. That was last cycle. It's not going to work for this cycle.
No, it's very clear. Should people want to learn more about Gavekal Research or about the China Fixed Income Fund, where do they go?
Yes. They can go on our website, which is gavekal.com, and you know, ask for information from there. That's usually the easiest way. We do have a Dutch representative, Henk van Heldijk, who can help out. So especially if you feel more comfortable speaking in Dutch, then Henk can answer any questions you have. But probably the easiest is to go through the Gavekal website.
Okay, I'll make sure that the contact details will be provided at the end of the video that we'll make from this. Thank you so much.
Thank you.
Very insightful, extremely insightful. Thank you for your time, and
thank you for your time
with your efforts.
Thank you very much.
Bye-bye.